Welcome back to the deep dive. We're here to cut through the noise, navigate the complexities of today's economic landscape, and really bring you those essential insights.
That's the goal.
So today, we're diving headfirst into something fascinating and honestly, at times, totally counterintuitive.
Hmm.
We're looking at this intricate dance between escalating trade tariffs, the, ever-present specter of inflation, and a stock market that seems, well, surprisingly resilient.
It really does.
Imagine the headlines, right? Trade war escalates, and then almost immediately after, stock market hits new records. It's a bit of a head-scratcher, isn't it, the learner?
It absolutely is.
It's like watching a tightrope walker navigate a storm, and instead of wobbling, they just break into a dance.
Yeah, that's a good way to put it.
So our mission for this deep dive is to really dissect the recent market observations, the expert analysis from our sources here. We want to understand why.
Exactly. The why is key.
Why, despite these mounting economic pressures, the kind that usually trigger alarm bells, did the stock market seem to barely flinch? What are those critical, maybe hidden factors influencing how investors feel, how companies are deciding things right now?
What's allowing them to defy what seems like economic gravity?
Right. We're going to unpack those layers, try and reveal the underlying mechanics.
And our goal, as always, is to help you quickly grasp the crucial insights, connect those dots that maybe others miss. We're not just telling you what happened.
Yeah.
We're exploring why it matters, what the underlying dynamics really are, and how these forces kind of weave together to shape that broader economic story.
Okay.
We'll dig into the data, the expert opinions, and then try to weave it all together so you can see the bigger picture and understand what it means for the market and, well, beyond. Let's peel back that first layer.
All right, let's do it. So this initial paradox that caught so many by surprise, our sources point to that specific moment in July. President Trump escalates the trade war, throws new, pretty substantial tariff threats onto the table.
Yeah, big ones.
Historically, moves like that create a fresh batch of inflation risks, right? Drives up costs for businesses, for consumers. You'd expect that to send shivers through the market.
Absolutely.
Ah,
Maybe even trigger a correction.
you'd think. But here's where it gets really interesting. Despite these very clear signals of pressure, the stock market, specifically the S&P 500, the Nasdaq Composite, they stayed remarkably stoic.
Almost unnervingly so.
Exactly. They didn't just hold steady. They both hit fresh record highs last week. Even after Trump doubled down on that new August 1st deadline for certain tariffs, vowed not to back down.
Still hitting records.
How can that be? It just feels counterintuitive, a defiance of what you'd expect.
What's truly fascinating here is exactly that initial reaction, or maybe more accurately, the lack of one.
Right.
You had very tangible signs of inflationary pressure, not just, on the horizon, but actually emerging in the economic data.
Like what specifically?
Well, take copper prices, for instance. Copper, they often call it Dr. Copper, right?
Mhm.
Because it's historically pretty good at diagnosing the health of the global economy.
Okay.
It was surging. And rising copper prices, they're often a sign of increased industrial demand, higher raw material costs, which feeds directly into inflation.
Makes sense.
Then you had the tariff pressures actually bubbling up quite visibly in corporate earnings calls. You heard executives talking about increased input costs, supply chain disruptions.
So it wasn't just abstract.
Not at all. And it wasn't just big industrial numbers either.
Yeah.
We were even seeing talk about everyday things like your morning coffee possibly getting more expensive because of these tariffs.
Wow, okay.
Yet facing all these clear signs of rising costs, potential inflation, investors just held firm. They seemed almost unfazed by these signals.
Which raises that big question, why? Why were they so calm, or why did they see these signals so differently? Was it just optimism or something deeper?
That's a good question.
So what does this resilience, this apparent indifference to trade tensions actually mean? We know Wall Street generally expected an uptick in June inflation, partly because of tariffs.
Right, that was factored in to some extent.
But the key insight from strategists like Terry Wisman at Macquarie Group is that the stock market might just shrug it off.
Shrug it off. How?
Well, he suggests it could be seen as, a temporary thing, a one-off increase, not a broader, more persistent shift in inflation dynamics.
Okay. The temporary versus persistent distinction.
Exactly. And that distinction is absolutely crucial for you, the learner, because a temporary blip, a short-lived price bump is way less likely to stop the Federal Reserve from cutting interest rates later this year.
which the market is clearly hoping for.
Definitely. But the question is still, why would they see it that way? What's behind this perceived desensitization?
Well, zooming out to the bigger picture, Wisman suggests that financial markets might have become, quote, desensitized to this specific type of inflation number.
Particularly the tariff-driven ones.
Exactly. It's not just investors ignoring headlines. It feels like a more calculated bet.
Yeah.
I mean, think about a market that's been hit repeatedly by tariff threats, policy shifts over the last few years.
It builds up a tolerance?
Sort of, yeah. A kind of immunity, maybe tariff fatigue is a good term. This desensitization, as Wisman points out, comes from maybe a deeper belief that these are temporary policy-driven blips.
Not symptoms of runaway inflation.
Precisely. Not systemic inflation. His reasoning is that investors have just grown more calm about the overall inflation outlook recently. Now, he clarifies he wouldn't go so far as to say the market's shifted entirely to a disinflationary mode, where prices are actively falling or slowing way down across the board.
Right.
Instead, he sees less inclination to worry about inflation as a primary market driver, at least, in this specific context of tariff bumps.
So it's perception. Is this a one-off or a fundamental shift?
Exactly. The key insight is the market isn't being irrational. It's recalibrating its risk assessment based on past patterns. It's fascinating, really, how that this too shall pass attitude can temper panic.
Even with alarming data.
Right. The market seems to be betting it's just noise, not a signal of a deeper problem that would actually change the Fed's path or investor behavior fundamentally.
Okay, let's dive into the specifics of that inflation data then, because the numbers themselves are pretty telling.
They are.
Economists polled by the Wall Street Journal, they expected headline inflation, that's the total rate, to rise 0.3% for June.
Okay.
That pushes the 12-month headline CPI rate up to 2.7%. That's a noticeable jump from 2.4% the month before.
Definitely an uptick.
But then there's core inflation.
Yeah.
And this is the one the Fed watches more closely, right?
Much more closely.
It strips out the volatile food and energy costs, gives a clearer, less noisy picture of those underlying price pressures. That was forecasted to increase 0.3% monthly and hit 3% annually. Now, that 3% annual core number, that sounds significant, doesn't it?
It does. On the surface, 3% core seems pretty high.
Feels like it should grab the market's attention, maybe worry the Fed. So what's the nuance here? Why the potential shrug off?
Absolutely. Those numbers are important. But this is where the composition of inflation matters just as much, maybe even more, than the headline and core numbers themselves.
The breakdown within the number.
Exactly. Wisman really emphasizes this crucial distinction. For now, tariffs are primarily expected to hit core goods prices.
Okay, core goods, like manufactured products.
Right. Appliances, apparel, things like that. And this is vital for you, the learner, to grasp. Core goods only account for about 20% of the overall CPI report.
Only 20%. That seems smaller than I would have guessed.
It is. So while tariffs might push up prices for certain goods, their overall weight in the big inflation calculation, that CPI basket, is relatively small compared to other parts. It's about understanding the internal structure of the report.
Okay, so if they mainly affect this smaller slice, core goods, why might markets ignore that, as Wisman put it? It still seems weird to just overlook part of the inflation picture.
This is where that nuanced perspective comes in, and it's really key to understanding the market's seemingly calm reaction.
Okay.
Markets are likely to largely ignore core goods inflation if, and this is a big if, services inflation continues to show signs of easing.
Ah, services. That's the bigger piece.
Much bigger. Think about the relative weights again. Services inflation carries way more significance, accounting for roughly 57% of the total CPI reading.
Wow, 57% versus 20% for core goods. That's a huge difference.
It really is. So the thinking is, if that much larger component services stays subdued or even shows signs of cooling down,
then the overall picture looks less alarming.
Exactly. Less alarming to the market, and maybe most critically, less alarming to the Federal Reserve.
Why is the Fed more focused on services?
Well, the Fed typically puts more weight on services inflation because it's seen as a better indicator of underlying demand and, crucially, wage pressures.
Things that are stickier, harder to reverse.
Precisely. They're generally more persistent than temporary price shocks from tariffs on goods. So, if the majority of the inflation basket, the service sector, is behaving.
Then a smaller, tariff-driven bump in goods might seem manageable.
Right, like a transient blip, less likely to provoke a strong policy response from the Fed. It's the difference between, say, a temporary surge in the price of imported widgets versus a widespread, demand-driven increase in your rent, healthcare, or dining out.
One is definitely more concerning long term.
Absolutely.
But this calm facade, it masks a pretty significant fault line, doesn't it? There's a real risk here.
There is.
Our sources mention that a hotter than expected June inflation report and Fed Chair Jerome Powell himself recently called this report among the most important for assessing the impact of tariffs.
High stakes, then.
Very. A hot report could significantly slow down the pace at which the central bank lowers interest rates.
And that
That could throw a serious wrench into the stock market's record run. I mean, the market's been riding this wave of optimism, partly fueled by expecting future rate cuts.
Mhm.
If those hopes get dashed, or even just delayed, it could completely change the script for how investors feel.
Indeed. That's the scenario that would really unnerve people and could quickly erode that desensitization we talked about.
So what would that hot report look like?
Well, if the June CPI report shows services inflation spiking again, especially if it comes along with a broader increase in price pressures that looks clearly demand-driven.
Meaning consumers are spending hard, pushing prices up, not just tariffs on specific goods.
Exactly. Then investors will get much more concerned that there's something underlying the numbers that is not related to tariffs.
It shifts from a supply-side blip to a deeper demand problem.
Precisely. A more entrenched issue of potentially overheating demand. And that scenario gives the Fed way more justification for delaying a rate cut or maybe even halting plans altogether.
Which is bad news for the market rally.
Definitely. For market participants hoping for lower borrowing costs to fuel profits and investment, that would be a major disappointment. Lower rates make borrowing cheaper, encourage expansion, make stocks look better than bonds.
So a delay puts the brakes on.
It could certainly put a significant brake on the current rally, forces a rethink on valuations, future growth. It's about distinguishing between that temporary distortion and a fundamental shift needing a different policy response.
Okay, but what about the consumer in all this? Jim Smigel, he's the CIO at SEI, had a really interesting take on consumer behavior amidst all this uncertainty.
Yeah, his point was quite insightful.
He seemed to suggest that despite all the talk of tariffs and inflation, the consumer might be feeling something, but not necessarily acting on it in a way that changes the big picture, like a psychological versus behavioral split.
That's a great way to put it. Smigel's point is subtle but important for you, the learner, to really pay attention to. He suggests that tariff-related inflation uncertainty might have primarily affected the consumer's mindset.
How they feel.
Right. Without significantly cutting back on consumer behavior. In other words, people might feel anxious. They might worry about their purchasing power, talk about it.
But they haven't stopped spending.
Not necessarily, or at least not in a way that signals a broad economic slowdown yet.
Yeah.
They haven't pulled back significantly on, say, discretionary purchases.
Which raises another question then.
It does. For inflation to be truly fading in a way that reassures the Fed and the markets, Wiseman says we need confirmation from discretionary components of the services basket.
Like what specifically?
He mentioned areas like airlines, used cars, apparel, furniture, these more optional expenditures.
So we need to look deeper into where the money's actually going.
Exactly. Are consumers pulling back on these types of purchases? If those areas are still seeing strong spending, it suggests that despite the uncertain mindset, actual consumer demand is still strong.
And strong demand, especially in services, could keep inflation pressures up, regardless of tariffs.
It certainly could. So it's not enough for just a through imported goods to get cheaper. We need to see a broader cooling in consumer spending patterns, especially in those key discretionary service areas, to really signal a cooling economy.
Okay, so the CPI report, hugely important, but just one piece.
One piece of the puzzle.
It tells us about prices, but not necessarily how businesses are actually feeling the heat on the ground, how they're coping.
For that, you need to look elsewhere.
Right. For that, we need to turn our attention to what's happening in corporate boardrooms on their balance sheets, and that, the learner, brings us straight to a major event on the financial calendar, the unofficial start of the second quarter earnings season.
Ah, yes, earnings season. Always revealing.
This is going to give us a fresh, very direct look at how corporate America has been adjusting to higher tariffs. They'll reveal their actual financial performance, give us a glimpse of their outlook.
And connecting this to the bigger picture, how companies are navigating these tariffs will be right there in their results and what management says on the calls.
We're talking big names too, right? especially financials.
Yeah, some of the largest U.S. financial services companies reporting, their performance is often seen as a bellwether for the broader economy, given they touch so many sectors.
Who's on the list?
Well, J.P. Morgan Chase, Wells Fargo, Citigroup, BlackRock were slated for Tuesday, then Bank of America, Morgan Stanley, Goldman Sachs on Wednesday.
So, the giants.
Pretty much. Their performance revenue, profit margins, and maybe even more importantly, their outlooks for the coming quarters will be absolutely critical in shaping how the market feels.
These reports will tell us if tariffs are eating into profits, disrupting supply chains, changing investment plans.
All of that. Are they passing costs on, absorbing them, finding new suppliers? Are they delaying investments? These are the questions earnings season should start to answer, things the CPI numbers alone can't fully capture.
Let's look at the numbers we were already seeing as earnings season kicked off, because they paint an interesting, maybe not entirely rosy, picture. According to John Butters, he's a senior earnings analyst at FactSet Research, the S&P 500's blended earnings growth rate for Q2 was looking like 4.8%.
4.8%. Okay, not terrible on its face.
Not terrible, but Butters notes it would be the lowest rate reported by the large cap index since the fourth quarter of 2023.
So a noticeable slowdown compared to recent periods.
Definitely. And it wasn't just the blended rate. For the 21 S&P 500 companies that had already reported when our sources were compiled.
The early reporters.
Yeah, it was a weaker start overall. Only 71% actually delivered earnings per share above estimates.
And how does that compare normally?
Well below the 5-year average of 78%. So yeah, not exactly a stellar start, right? Tangible signs of underperformance seem to be filtering through.
That data certainly suggests underlying pressures are hitting corporate performance directly, and Wisman links this slowdown straight back to the tariffs.
Oh, so.
He notes that they've produced a lot of uncertainty that has delayed companies' purchases and investment decisions.
Makes sense from a business perspective.
Totally. If you're an executive, unsure about future costs, supply chain stability, even demand because of potential price hikes, you tend to get cautious.
You pause big spending plans.
Exactly. Delay capital expenditures, hold off on factory expansions, defer equipment investment, maybe even postpone inventory buys until things are clearer.
And that caution, that hesitancy.
It could directly explain why corporate revenues might be a bit on the weak side, as Wisman put it. It's not necessarily the consumer demand vanished, but the broader economic engine is sputtering because of that lack of visibility. They're playing a waiting game.
But there's a fascinating flip side here, isn't there? A potential silver lining, Wisman pointed out.
Yes.
He suggests this very weakness, this underperformance in early earnings, could actually set the stage for something positive later on. How does that work? Feels contradictory.
It does sound counterintuitive, but what's fascinating here is the possibility that this current weakness could actually set the stage for earnings to surprise to the upside in future quarters.
Okay, how?
It's not just wishful thinking. It's rooted in specific macro dynamics, particularly the recent weakness in the U.S. dollar.
The DXY index.
Right, which tracks the dollar against other major currencies. Now, how does a weaker dollar help U.S. companies with big overseas operations?
Makes their goods cheaper abroad?
That's part one, yeah. It can boost export demand, sales volumes for companies selling internationally, but crucially for margins.
What happens when they bring the money back?
Exactly. When these U.S. multinationals convert their earnings made in foreign currencies, euros, yen, whatever, back into U.S. dollars, those foreign earnings are suddenly worth more.
Ah, like a currency bonus.
Precisely. It's like their overseas profits get an automatic boost, providing a powerful tailwind to their reported earnings.
So tariffs might be a headwind domestically.
But a weaker dollar acts as a powerful offset for globally diversified companies. It could lead to better than expected results down the line as those currency effects show up in their financials.
An unexpected cushion.
Exactly. Yeah. Classic example of interconnected global factors creating unexpected opportunities, even amidst localized pressures like tariffs.
Okay, moving beyond past performance and current earnings, our sources highlight something Jim Smidgel from SEI flagged as absolutely crucial. The intense focus on corporate guidance, or maybe more accurately, the lack of it.
Yes, the guidance gap.
And this isn't new, right? It's been a growing trend signaling this deeper, kind of pervasive uncertainty in boardrooms that really impacts investor confidence.
It really does. And the data from Rational Wealth shows the scale of the problem. In Q1 2025, only 16% of reporting companies actually issued guidance for future quarters.
Only 16%. Wow.
Yeah, compare that to 27% during the same period in 2024. It's a dramatic drop.
Which raises that important question for you, the learner.
No.
Why are so many companies holding back? And what does it mean for investors when that roadmap is just missing?
Well, guidance usually provides that crucial roadmap, right? Lets investors forecast earnings, project cash flows, value a stock accurately.
So when it's missing,
It injects a huge amount of uncertainty, makes it harder for analysts to model performance, harder for investors to make informed decisions, often leads to more volatility because everyone's kind of flying blind.
it means the companies themselves are struggling to predict their own future.
That's a powerful signal in itself. Signifies ongoing economic murkiness.
Smidgel called this lack of ability for some U.S. companies to issue guidance the bigger problem last quarter, even bigger than the actual earnings results.
That's a strong statement.
It is. So if companies are essentially clamming up, unable or unwilling to give a clear path forward, what are investors really watching for now? What signals from these earnings calls will give them the confidence they need?
Smidjo makes it really clear. Investors will be watching closely to see if these firms have more confidence to be able to offer something for investors for the second half of the year.
Just confidence.
The ability or inability to confidently project future performance speaks volumes. It tells you about their visibility into future demand, supply chain stability, input costs, the regulatory environment, especially tariffs.
So if companies do start issuing guidance again,
If a significant number regain enough confidence to issue forward guidance, even if it's conservative guidance, it signals they see a clearer path ahead. Less uncertainty, maybe improving conditions.
and Smidgel thinks that could boost the market.
He believes if companies feel more confident to issue guidance, that could be a big boost to the stock market for the rest of 2025.
Why such a big boost?
Because certainty often translates into higher valuations, increased investor appetite, the risk premium tied to uncertainty starts to shrink. It would be like a strong vote of confidence from corporate America itself,
Suggesting they've figured out how to navigate the choppy waters.
and can see a less tumultuous horizon. That would be significant.
Okay, let's bring it right up to the present then. See how these dynamics played out very recently, kind of challenging that earlier desensitization idea?
Right, because the market did react.
It did. Our sources mentioned U.S. stocks finished lower last Friday, and this time the market reacted quite noticeably, the trigger. President Trump announcing that big 35% tariff on Canada effective August 1st.
Yeah, that got attention.
Immediately after that news, the Dow was off nearly 280 points, about 0.6%. S&P 500 fell 0.3%. NASDAQ lost 0.2%. So after all that talk about the market barely flinching,
This one hit a nerve.
it seems like it, this specific tariff on a key partner like Canada, why the sudden change? Why react this time?
Well, this recent reaction really highlights the ongoing sensitivity to new, direct, and maybe unexpected tariff actions.
Even if the broader inflation outlook seemed desensitized earlier.
Right. It suggests that while investors might have factored in or become less reactive to existing or maybe more generic tariff threats, like a boy who cried wolf situation,
Okay.
a new, specific, and particularly high tariff on a really close trading partner like Canada still registers as a significant uncertainty shock.
Why Canada specifically?
Because Canada isn't just a neighbor. It's a deeply integrated trading partner. New tariffs there could have more immediate, widespread supply chain disruptions and cost impacts on U.S. businesses.
More tangible, maybe.
Potentially, yes.
Yeah.
It just underscores the continued volatility and potential for disruptions from trade policy. The market's reaction here signals the trade war is still a major variable.
Capable of causing tremors when the action is new and impactful enough.
Exactly.
Yeah.
It's a crucial reminder that market desensitization definitely has its limits, especially when fresh, concrete policy decisions hit the table that can directly impact revenues and stability.
So what does this all mean for you, our listener, the learner? We've covered a lot of ground. We talked about the market's initial, almost perplexing resilience despite clear inflation risks. We dissected the CPI breakdown, why services inflation is so critical for the Fed. We delved into the early signs from corporate earnings, the pressures they're facing, but also that unexpected silver lining from a weaker dollar.
Right.
And crucially, we highlighted the growing importance of corporate guidance, or that concerning lack of it, as a key indicator for what happens next.
It's a really complex tapestry, isn't it?
It truly is. Every thread pulls on another, creating this dynamic, often unpredictable economic environment.
And when we consider this complex interplay, tariffs, inflation composition, earnings pressure, that guidance gap, It makes you ponder, doesn't it?
What's the big question it leaves you with?
How long can the stock market's apparent desensitization to this tariff-driven inflation really last? Especially if services inflation were to accelerate again, signaling broader price pressures.
Or if that lack of corporate guidance persists.
Exactly. If that signals prolonged, pervasive uncertainty across businesses, these are the deeper questions that remain. They challenge the market's current balance, potentially shaping the story for the rest of the year.
It forces us to ask, is this resilience a sign of underlying strength or just a temporary calm before a storm of unresolved uncertainties?
That's the core tension, I think.
It certainly leaves us with a lot to consider. We've unpacked a significant amount here, looking at how these forces interact, what signals investors are really watching beyond the headlines.
Hopefully giving a clearer picture.
We hope this deep dive has given you that clearer picture, maybe some aha moments, and perhaps a new lens to view this intricate dance between policy, prices, and market sentiment.
Understanding these nuances is absolutely key.
It really is key to staying informed, navigating the financial world. Keep those questions coming, and we'll be right here ready to dive deep into whatever fascinates you next.
Looking forward to it.
Until then, keep learning and stay curious.